In 2023 and 2024, the United States stock market went on a historic tear. Portfolios recovered from the 2022 bear market, and it felt like the only mistake an investor could make was sitting on the sidelines. But right in the middle of that roaring bull market, Warren Buffett started executing the largest stock sell-off in the history of Berkshire Hathaway. This diagram compares Berkshire Hathaway's cash reserves against national economies. By early 2026, Buffett had stockpiled nearly $400 billion in cash and short-term U.S. Treasury bills. That single pile of money is larger than the entire annual economic output of countries like Finland, Portugal, or Chile. It didn't appear overnight. He built it deliberately, quarter after quarter, selling steadily while markets hit record highs. Every business show on TV called this smart tax planning. The theory was Buffett was simply trimming his tax bill before capital gains track record. In 1986, the corporate tax rate was scheduled to jump from 28% to 34%. He didn't panic sell a single core holding. He sat still. Tax rules have never once forced him out of a business he believed in. Then, on January 1, 2026, he stepped down as the day-to-day boss of Berkshire Hathaway, handing control to Greg Abel. The massive cash pile was already in place before the transition, and Abel's first move as the new chief? He kept right on selling. Buffett's favorite holding period is famously forever. Swapping billions in stable businesses for government paper suggests he is no longer looking at the current market highs, but at the specific data points that aren't yet making the headlines. There are only two other moments in his long career where Buffett stepped back from stocks almost entirely. First, in 1969, during the Nifty 50 bubble, he closed his partnership and gave his investors their money back. 30 years later, he publicly pushed back against the dot-com mania, where companies with zero profits, like Pets.com, were valued in the billions. In both cases, he saw a massive gap between what companies were worth and what people were paying to own them. This graph tracks what is known as the Buffett indicator. It takes the total value of all stocks and divides it by the size of the real U.S. economy. Buffett has warned that if this ratio approaches 200%, you are playing with fire. It hit that level in 1999, right before the Nasdaq crashed. By early 2026, driven almost entirely by a concentrated handful of tech giants, it was back in the red zone. This chart shows the disconnect perfectly in what used to be his untouchable favorite, Apple. Between 2022 and 2024, Apple sales grew by about 1.5% a year. It was a successful company, but growth was crawling. Meanwhile, investors bid the stock price up to more than 30 times the company's annual earnings. The stock and the actual business were telling two completely different stories, so Buffett gutted his position, cutting it from half his portfolio down to about a fifth. Apple wasn't the only tech giant with stretched numbers. The biggest tech firms poured hundreds of billions into artificial intelligence gear. NVIDIA funded OpenAI. OpenAI used the cash to buy NVIDIA chips, and Microsoft handed out billions in cloud computing credits to keep the system running. The money spun in a tight, closed loop of corporations paying each other, with painfully little profit flowing in from actual outside customers. Buffett's late partner, Charlie Munger, spent his final days warning that this AI frenzy looked exactly like the wild speculation of the late 90s. The entire tech sector is borrowing against a future that isn't arriving fast enough, creating a massive valuation bubble that Buffett refuses to participate in. High stock valuations alone don't trigger a record-breaking liquidation. The real warning signs were flashing quietly underneath, out in the real economy. This chart tracks the SOM rule, one of the most reliable recession indicators in modern economics. It monitors a very specific shift in the job market. When the 3-month average of the unemployment rate climbs half a point above its lowest level from the past 12 months, a recession has likely already begun. In the 11 recessions since 1950, this alarm sounded every single time. In August 2024, the reading crossed that red line again. Look closely at this timeline. Buffett's most aggressive liquidations map almost perfectly to that exact alarm. He slashed his Apple stake through the spring of 2024 and then began unloading Bank of America all through late summer and fall. At the precise moment companies started cutting real jobs, the most careful investor alive was already heading for the exit. That labor data was closely followed by a massive signal from the bond market. For 2 years, short-term bonds paid more than long-term bonds, a pattern known as an inverted yield curve. Think of the inversion like an earthquake warning system. It's the low rumble letting everyone know tectonic pressure is building. Everyone braces during the rumble, but the real damage doesn't happen during the rumble. It happens when the shaking stops and the ground violently settles. In finance, that settling is the uninversion. As 2024 rolled into 2026, the curve began climbing back toward normal. It normalizes because the Federal Reserve finally sees the cracks forming in real time and rushes to cut interest rates. The uninverting curve proves the people with the most data have decided the ground is about to move. This brings us to the most alarming exit of them all. Back in 2011, Buffett was the white knight who personally saved Bank of America. Yet, starting in mid-2024, he began ruthlessly dumping his massive stake in the very institution he once rescued. A hidden pressure is building on bank balance sheets, held-to-maturity bonds. During the era of cheap money, banks loaded up on low-interest government debt. When interest rates suddenly climbed, the market value of those old bonds plummeted, leaving lenders with billions in assets that are quietly bleeding value. This diagram compares the scale of that damage. By 2023, Bank of America was sitting on over $100 billion in paper losses from those bonds. That black hole is nearly 7 times larger than the loss that triggered the rapid collapse of Silicon Valley Bank. Right now, those losses are just on paper. A bank can survive simply by holding the bonds until they expire and collecting the full payout. But that only works if they can afford to wait. If a recession hits and panicked depositors start asking for their cash back, waiting is no longer an option. The bank is forced to sell those bonds immediately, turning a theoretical loss into a fatal one. Nearly every major American lender loaded up on those same cheap bonds. Buffett understands the mechanics of banking better than almost anyone alive. By exiting Bank of America now, he is sidestepping a systemic trap that waits for the next liquidity crisis. Look at the complete picture. You have a technology sector priced for a future that hasn't materialized. You have a triggered labor market alarm. You have an uninverting bond curve signaling emergency rate cuts, and an entire banking system sitting on hundreds of billions in buried losses. They all converged at the exact same time. For Buffett, cash functions as high-potency stored buying power. When markets are expensive, cash looks like a lazy asset. When markets break, it becomes the ultimate tool of opportunism. He is preparing to run his 2008 playbook on a much larger scale. During the 2008 financial crisis, while the rest of the world was scrambling for cash, Buffett stepped in as a ruthless liquidity provider. He handed lifelines to desperate giants like Goldman Sachs and General Electric, securing terms so favorable they are still taught in business schools today. He had cash in hand and the nerve to deploy it when everything was cheap. This changes the entire context of him handing day-to-day control to Greg Abel. An investor who believes the good times will last forever doesn't spend his final act as boss liquidating the portfolio. He wanted to protect Berkshire Hathaway and give it a solid foundation. He handed Abel a loaded financial weapon and gave him one simple order: wait. While the rest of the financial world continues to celebrate a roaring market, history's greatest investor has deliberately stepped off the floor. He has stacked nearly $400 billion in the vault, and now he is just waiting for the music to stop.